An actively managed fund pays people to choose investments. An index fund can look like it has nobody in the driver's seat. So why do so many active funds still finish behind the benchmark? Start with one careful comparison. In the SPIVA US year-end 2025 scorecard, 78.78% of active U.S. large-cap funds underperformed the S&P 500 over 1 year. Over 10 years, the figure was 85.59%. Over 20 years, it was 92.89%. Those are 3 results for one named category and its benchmark, with data through December 31st, 2025. They do not show that every active manager loses or that an index fund wins every year. Categories and periods differ, and past performance does not guarantee future results. But the comparison gives us a useful question. What structural hurdle does an active fund have to clear? We will separate the index from the fund, open the rulebook, examine diversification and costs, compare mutual fund and ETF wrappers, and end with 5 checks. First, an index is not an account, and it is not a fund. A market index measures the performance of a defined basket of securities, such as stocks or bonds. You cannot invest directly in that measurement. An index fund is an investable vehicle that seeks to track an index's return. It may be organized as a mutual fund or as an exchange-traded fund, an ETF. Think of a road test. The index defines the route and records its performance. The fund is the vehicle trying to follow it while paying real operating costs. That phrase, seeks to track, matters. One fund may hold every security in its index. Another may use a representative sample. Either can finish a little ahead of or behind the index during a particular period, but fees, trading costs, and tracking error can cause the fund to underperform its target. The promise is a declared benchmark and a fund designed to follow it. Passive does not mean that no humans operate the fund. An active fund manager makes portfolio choices without conforming to an index within the fund's disclosed objective and strategy. A traditional index fund builds around a selected index. The index itself still has rules. Those rules determine which securities enter the basket and how much weight each receives. Many indexes use market capitalization, so companies with greater market value receive greater weight. Other indexes can use a different weighting method. The fund may own all constituents or a sample while trying to keep its results close to the benchmark after trading and expenses. So, index alone tells you little. A broad market index and a narrow index can both be rules-based while producing different holdings and risks. The driver's seat is not literally empty. The key distinction is that a rule-based target replaces repeated security selection predictions. One appeal of a broad fund is diversification, spreading money among different investments to reduce risk. Mutual funds and ETFs can make it easier to own small pieces of many securities. Spreading a portfolio across genuinely different holdings reduces dependence on one company's outcome. But diversification is not a force field. A mutual fund or ETF is not necessarily diversified, especially if it focuses on one industry. Several funds can also hold the same top companies, hiding overlap, and a diversified fund can still lose money. ETF and mutual fund investors can lose some or all of the money they invest because the securities inside a fund can fall in value. Ask how many holdings are in the basket and where the weight is concentrated. Now we can resolve the title without turning it into a slogan. Active management has the potential to outperform, but after a fund makes its choices, the investor receives the result after the fund's costs. The SEC puts the relationship plainly. A higher-cost fund must perform better than a lower-cost fund to generate the same return for the investor. Index funds generally make fewer purchases and sales than actively managed funds and may save some management costs. May is important. The SEC also warns that not every index fund has lower costs than every actively managed fund. In SPIVA's large cap comparison, the majority underperformed over 1, 3, 5, 10, 15, and 20 years. Rates changed by horizon, and mid-cap and small-cap results differed. The defensible conclusion is not experts always lose. An active fund must add enough value to overcome its costs. A low-cost index fund instead needs to follow its declared basket efficiently. Here is a simplified illustration of that cost hurdle. Start 2 hypothetical accounts with $10,000. Assume each earns the same smooth 7% gross return for 30 years. Make no additions or withdrawals. Ignore taxes, loads, commissions, spreads, advice fees, other trading costs, and return variability. For account A, subtract a 0.05% annual expense assumption from the 7% gross return. Under annual compounding, the ending value is $75,062.61. For account B, subtract a 1.0% annual expense assumption. Its ending value is $57,134.91. The difference is $17,627.70. Only the assumed recurring expense changed. This is not a forecast. Returns can be negative, and real expenses are deducted through fund operations rather than this simplified subtraction. The example isolates why a persistent annual gap compounds. And the expense ratio is not necessarily the whole bill. A fund's prospectus separates annual operating expenses from shareholder fees, while commissions and some intermediary costs may sit outside that table. A fund advertised as zero expense can still involve other costs. The quiet number is not always the only number, but it deserves attention. An index strategy often comes in one of 2 wrappers: an index mutual fund or an index ETF. A mutual fund investor buys from and redeems with the fund directly or through an intermediary. The transaction uses the next calculated net asset value, or NAV, plus or minus applicable fees. ETF shares trade with other investors on an exchange while the market is open. The market price can be above or below the ETF's NAV, so the price you pay may differ from the value of the underlying portfolio. That trading structure can add costs. Depending on the account and transaction, an ETF investor may encounter a brokerage commission, the gap between bid and ask prices, or a premium or discount to NAV. Neither wrapper wins automatically. Their expense ratios, transaction mechanics, minimums, automation, and account-level costs can differ. Compare actual products rather than assuming ETF or index settles the decision. Here is a 5-check filter for evaluating a fund. Check 1. Benchmark. What index does the fund seek to track? How does that index select and weight its holdings? Check 2. Breadth. Does the basket cover a broad market, or is it concentrated in a sector, theme, country, or small set of top holdings? Multiple funds can overlap, so inspect what is actually inside. Check 3. Cost. Read the prospectus fee table for the exact fund and share class. Then account for any load, commission, spread, account fee, or advice fee that applies in your situation. Check 4. Tracking. Compare the fund's performance with its stated index over matching periods. Remember that fees, trading costs, sampling, and tracking error can create a gap. Check 5. Fit. A broad stock fund can still fall. Time horizon, risk tolerance, and the rest of the portfolio matter. Benchmark. Breadth. Cost. Tracking. Fit. Past performance does not predict future returns. So why do the experts often lose? Not because expertise is imaginary, not because nobody can beat an index, and not because index funds are guaranteed to make money. The narrower answer is that an active fund must make choices that outperform by enough to clear its costs. The SPIVA scorecard shows that many active funds in its measured categories and periods did not clear their benchmarks. A traditional index fund accepts a stated benchmark and tries to keep the gap between fund and index small. That is what the empty seat means. It is a visual metaphor, not a literal claim. Humans create and operate the product, but a rules-based index target sets the portfolio's direction instead of a star manager making a new forecast at every turn. Choose the benchmark before the brand. Check weight, not just holding count. Treat cost as a hurdle. Understand the wrapper, and remember that diversification can reduce dependence on one holding without preventing a market loss. This is general financial education, not personal investment, tax, or legal advice. Past performance does not guarantee future results. If index funds finally make sense, subscribe to Plainly Money. No hype, just money, plainly.